Yes, I got a great webinar called Become Part of the 9% and on 91% lose in spread betting. And you've got to, there are so many things you would need to do to become part of the 9%. If it were that easy, everyone would be part of it. And there's a lot of intelligent people making up part of the 91%. And in fact, you will always vacillate. You'll be in the top 1 and occasionally you'll be outside the 9%. But what you do need to do is you need to potentially decide on a strategy that looks after all elements of money management. And we've discussed the risk reward, we've discussed losses. You've got to manage losses, that keeps you in the game. You've got to believe you have a system that will make more than it gives back on its winning. It will win and will lose all the time. No one is ever going to have 100%. So accept that losses are part of the game and manage that. Become as systemic as possible in determining what your setup is. So the more it can be reduced to logic, the better, and the tighter. And then you need to stick to the system as systemically as possible as well, which most people are incapable of with emotions, particularly after, say, 3 losses. You'll be snakebite fearful, and after 3 wins, you'll be piling on twice the size. And that'll be the one that'll lose and give back all of those 3 wins and some. So that's where focusing on, if you had to develop a black box system, is not a bad process for defining your strategy and that which you find interesting. Observing charts, a lot of observation, a lot of drawing of charts, and a lot of use of patterns. Patterns are probably the most powerful technical analysis tool for me, outside of the larger trend Dow theory.
What are some trading mistakes to avoid?
Most trading mistakes made by beginners, even intermediates and occasionally even advanced people when they lose their heads, is to do with trade sizing. So they take a loss too big. There's no damage done in taking your managed loss. That's part of the game and being wrong. The problem is that recovery ladder when you then emotionally negatively respond to taking an already slightly bigger loss. So let's say you lose 15 or 20% and then you think, damn, I want to get back to where I was, so I need to make 25%, so I'll trade bigger again. I'm sure I'm right this time. You can't cope with the mental, it's like a mental cognizance dissonance, cognitive dissonance that makes you need to get back to where you once were, because you're now seeing yourself as the lesser self as dictated by this balance. And that then pressurizes you into trading bigger again on what looks like a sure thing. But now you're punch drunk because you must find an opportunity quickly. And it's not a sure thing. It's the first thing you grabbed hold of that best represents a possible trade. So you then bastardizing your criteria to grab hold of something that you expect to leverage you back into where you once were. This is a very big fatal spiral, because once again you then overtrade because you've got to make back more to get back up, and that's the recovery ladder concept, and boom, that is probably the single most destructive that sees someone have a £10,000 account reduced to a few hundred or £1,000 and then virtually giving up, realizing that they've blown it. Size.
It's 91% of people are in that sort of category.
I wouldn't say 91% are in that category. They don't all blow their accounts up from £10,000 down to 9, but they aren't possibly consistent with money management as a whole. And sizing is one element of money management. Don't forget, I said risk reward should be central to that as well. So they're taking trades that aren't worth the squeeze. The juice isn't worth the squeeze, and the probability of win rates, they haven't tested what likelihood they have of winning. Too tight a stop, something else I've mentioned. All of those things all fall under the larger money management cluster, and those are all key.
So do you agree with this statement? The only way to make money is slowly and steadily over time, not trading forex, indices, commodities, etc., because they're a giant casino.
No, I wouldn't agree with that statement at all. Those underlying markets can be traded profitably on a consistent basis. There isn't an efficient market hypothesis that truly keeps everything at true value. Anything that involves people will have reactions and overreactions and underreactions. So no, I think you can. I think I wouldn't be in the game if I didn't feel that there was an edge that could be taken.
So how good or bad was your performance when you first started trading?
Oh, shocking! Absolutely shocking. Like I said, probably between sort of like the peak of the .com, 1999, whatever, to probably 2003 when the market slumped, I probably lost about half my money, and it was a lot of money. So it was like, oh my goodness, and. Yeah, so then it was a case of building up from that again.
So over the years, what have you learnt that's changed how you approach the markets?
Yeah, I think, probably one of the biggest things is this thing about avoiding the blue sky story stocks. That's the mistake we all make. And I think, I'm not saying that blue sky stuff always fails. Some do work. But the trick is to put small amounts of money into them, just to put, say, 1% or less of your portfolio into the speculative stuff. And then you put your bigger amount, 4, 5, 6% of your portfolio into big quality, proper companies. And I think that's really important. The other big discovery for me, and I think this is it's an accident of who I am in a way, I think, I guess, was I got quite fascinated by technical analysis, by the charts and all that kind of stuff. And I love that. I find it fascinating. And because of that, I think that really helped me, because I think a lot of people are sort of investors and they just buy companies on their fundamentals and whatever, and they don't really understand anything about charts. And I think if you can actually amalgamate the two systems, so you're using fundamentals and you're using charting and layer them across, I think that works pretty well. And I think that's probably something that can give you an edge.
We hear that quite a lot, actually, that some people are just really drawn to the charts, and the amalgamation is what works.
And see, I think if you're just a technical trader, I think that's quite hard work. And I personally find it boring. It wouldn't interest me at all. But I think the idea of using the fundamentals to select the companies you want to be invested in, and then using the technicals to help get your timing right. So it's the timing of when you make your initial purchase, when you make any top-up purchases as the share rises or whatever, and when you scale out of the position when it's done really well. Those technical analysis definitely helps.
What's the best investment advice that you ever received?
Best investment advice? Probably just that diversify thing, and I luckily got it right from day one, was that diversification is so important. Do not have all your eggs in one basket. You're just going to get your ass kicked.
Do you have any favourite rules when it comes to trading?
I only make decisions out of trading hours. And it's one of my favourite rules. And it's back to Kahneman and your fast and slow brain. It's like, you got to make a decision about whether you buy or you sell, or you hold or whatever. You got to make those decisions when you're calm, you're relaxed, you're rational, you're thinking in a very logical way. If you're making those decisions during the trading day when the shares are going up and down, it affects your emotions. It's amazing how you think to yourself in the morning, right, I'm going to buy some more shares in Entertainment One today. And you've decided that. So you go to do the trade and they're down 4%. You're like, oh, I don't want to buy them now because they're falling. Where in reality, perhaps you should be buying them because they're cheaper now, they're down 4%. But because you've got yourself into this emotional state. So the better thing to do is to make the decision the night before, I am going to buy Entertainment One, whatever happens. And then the decision is made somewhere during the day. Okay, it might be down 4%. So you might say, right, I'm not going to buy them just this second, but I'll have another look at 2 o'clock and I might buy them then. but you have to execute that trade. And that's the way I work. I basically set myself a rule the night before. I have to do that trade tomorrow. I will do that trade.
What do you think are the biggest mistakes that novices make?
The obvious one is just buying junk. Everyone buys junk, and we all do it. Everybody in investing starts off buying rubbish, and miners and drug companies and whatever. The thing to realise is you can make money on miners and biotech and that, and people do. Some people do really well on it, and it's a very specialist thing. But the thing to realise is that they are trades; they are not investments. So what you do is you buy them and then you sell them. And you're just trading them all the time. Whereas they do not, don't think you can buy shares in this gold mine somewhere that's just discovered. You've just got a license for some gold in Botswana or something. It's not going to happen. It's like you'll buy shares in it, they will go down. And this idea that it's a long-term investment, no, it'll just keep issuing new shares. You'll get more and more diluted, and at some point it'll go bust or whatever. That's what happens.
A lot of people, I suspect, would like to become full-time traders. How much capital do you think is a realistic start amount?
I mean, obviously, it really depends on what your outgoings are. I mean, I'm quite lucky because my rent is cheap as chips, and because of my disability, I find flying abroad and staying in foreign hotels and that an absolute pain. So I'd rather not do it, So that saves me a lot of money, and so I just don't spend money. I mean, it's shocking how little I spend. I think I actually run 2 cars, believe it or not. And I think last year I only spent on my living expenses and rent and the 2 cars and whatever. It was ridiculous. It was like 15 grand. I just don't spend money. I'm not, I don't go in Waitrose shopping or anything, I'll just buy stuff from Tesco's or whatever, but
So if somebody was starting out realistically and they want to become a full-time trader, how much disposable would they need then, do you think?
I reckon for a normal person who has a bit of a life, whatever, I would say you probably need something like 250,000. That kind of level, I would think. I think if you... And obviously, 250,000, if you're making 10% a year, that's 25 grand. But of course, that assumes it's all in ISAs, so you avoid the tax side of things. It's... The trouble is you need to have more. It's like if you're spending 20 grand a year living, you need to be making at least 25 because you need to be adding to your capital. You've got to keep growing your capital so that you allow for inflation and whatever. So I think, it's very hard to do it on less than 250, I would say. And funnily enough, Robbie Burns, a naked trader, who's like, pretty much everyone knows him in the share world. He's an absolute legend. He's brilliant. He reckons about 250,000.
So if you had that and you were doing well, you'd be generating enough to live off and not have to go to work. And do you know personally any traders that just trade for a living?
I know a few, yeah, quite a few. And again, since I've been doing Twitter, I've sort of like got exposed to a lot more of them, And I mean, it's incredible. I mean, there's people like, David Strader, Carlin's fella, they've made incredible returns. They've been making like 20% a year for year after year after year. They just do so well, on big pots as well. And so it is doable,
It does seem to be a feeling out there that people think that trading is doing not a lot with very big rewards and making loads of money with very little effort. But from the interviews that I've done with traders like yourselves and from talking to you today, I mean, that is certainly seems to be a really big myth.
I think it is a huge myth. And I think one of the big problems people have is their expectations are too high. It's like, if you have a target goal of making 10% a year, you will take the right amount of risk to enable you to do 10% a year. You won't take too much risk. You won't, But the problem is, if you want to do 60% a year, 100% a year, you're just going to take on too much risk. And if you're trying to do 100% a year and taking on a massive amount of risk, you're going to end up losing 40% a year. And once you start losing, once you start burning your capital, you're in trouble. As a full-time trader, you've got to protect your capital. That is like the most important thing.
A lot of people like the idea of the excitement of trading. So they trade on, say, exciting companies, like the idea of the get-rich companies, like mining, oil, gambling.
Yeah, it's the classic.
What's your thoughts on that? I mean, you did mention that Red 52 that you...
Yeah, 32 Red, TTR. I mean, it really, it's that thing that, you should invest in boring companies. Yeah, that's true to a point. I mean, I think if we're talking exciting as in graphene, as in nanotechnology, as in blockchain, then all that is a waste of time. You're going to lose your money on it. But if you're talking exciting as in, Boohoo, which is like exciting bit of clothing retail, but it's a proper business. It makes money, it's growing well, it's paying it, So it's hard to just say, exciting. It really depends on people's definition of excitement, doesn't it? A boring stock can be pretty exciting if it makes you 300%.
Yeah, absolutely. So do you think in one way it may be sounder to buy boring companies?
I think what it really means is back to this junk thing again. It's back to buy proper businesses, not story stocks, not things that are like, we're going to make us all millionaires tomorrow. You don't want stocks like that. You want the stocks where they're real proper businesses generating revenue, generating profit, generating dividends. That's what you want. And if you chase all these blue sky story stocks with the latest innovation and this, that, and the other, you're just going to lose money.